Hello, everybody, and welcome to the 2022 One Sustainability Conference, our annual global sustainability event. We now have the pleasure to welcome Rebecca Self, founder and managing director of Seawolf Sustainability. Rebecca will tell us more about Net Zero 2050, greenwashing, and the accounting challenge of our lifetime. Thank you very much, Rebecca, and I hand over to you.
Thank you very much, and welcome everyone today. As said, my name is Rebecca. I'm speaking today from the Netherlands, where I live, but as you've probably guessed, I'm from the UK. I am a chartered accountant by background, and I actually started studying for accountancy back in 2007, and I qualified in 2013. But this week in 2013. So it seems an appropriate time. And I'll be focusing my presentation today a little bit more on accounting, which is a little bit different for me, and also attempting to make the topic more interesting than perhaps people might anticipate. And firstly, a bit more of an introduction to me. So my company, my freelance consultancy, is called Seawolf, and often people ask me where this name comes from. It's the Anglo-Saxon version of the name Seawolf, is my surname Self. So Seawolf is a Viking name. It comes from the Norse, meaning helping others, building relationships, a little bit Game of Thrones like. And when the Vikings came to the UK, came to England, it got abbreviated into the surname Self, which is my surname. I've worked in the financial industry previously for around 20 years, and I've been in the ESG space for roughly 10 of those years, and I was the CFO of Sustainable Finance at HSBC. And then final slide, talking about what I do. So I provide advice and training, gap analysis, and looking at regulatory requirements in the sustainability area. And that means helping organizations, often of all shapes and sizes, all around the world, as they get started with their own sustainability journey, training, awareness sessions, and looking at those new areas. And it's sustainability in quite a broad way. So that means carbon emissions, which we'll focus on today, but also looking at topics like biodiversity, water, pollution, and also social topics as well. So quite a broad range. For today, this will be mainly from a practitioner perspective. So there's lots more that could be said from a technical side, but it will really be from a practitioner perspective. And the presentation will be split into three main sections: some context, then going into Net Zero 2050, and then finally a focus on greenwashing, what that is, and some suggestions from accounting. So getting started, and I was actually doing some research to prepare for this presentation. So the very first accounting or measuring of financial information was in Egypt and Babylon. So it's something that's been around for a very, very long time, and that's counting of things. And at that time, it was the estates, the land, and also gifts and other such areas. The Romans also had quite a sophisticated accounting system, and that was measuring all of the various grants and receivables from their different regions, and then a consolidation, which happened in Rome. The abacus, as you can see here, is a very ancient instrument that was used for counting. In England, and I should say Wales too, and Scotland, that the Chartered Institute of Chartered Accountants in England and Wales was given its royal assent. So it became a formal royal institute in 1880. And in the US, that happened in 1887. So the institute was formed in the US. And in Canada, that happened in 1902. So there's an institute formed of accountancy. So there's been many institutes set up to set up standards, training, awareness around accounting. And IFRS, which is the international set of accounting standards, that was created in 2003. So about 20 years old now, been talked about for decades. And that was to create an international harmonization and a common language for accountants all across the world. And part of the reason I'm starting here today is just to ground the presentation in first principles, and you'll notice that as we go through, and then the read across to the challenge where we are today with carbon. And just as a small aside, to anecdotes from this morning, as I was preparing, I was showing a colleague this presentation and the picture of the abacus, and we were talking about using an abacus, which is what I used at school when I was learning my times tables. I'm quite a visual learner. And this person who's younger than me had absolutely no idea what I was talking about. So I'm not sure if that's consistent, but I found it really interesting that perhaps that's a different way of teaching now in schools. It could be. I certainly found it very useful in the past. And it just made me think about the challenge of counting physical things. And for some people, something that's physical is easier somehow to get your head around. And then a second anecdote from this morning, I was looking and searching for photos of girls or women with abacuses or counting. And there's a particular website I use for that. And I was shocked at the very few photos that there are. And overwhelmingly, those photos are of men and boys. So it was just another small anecdote as I was doing my research this morning. And why do we have accounting? And then also, what's accounting and economics and the difference? Well, when I was taught economics, which I studied at university, I was told if you want to figure out the price of something or the value of something, you get your demand curve, your supply curve, and then you have your price somewhere in the middle. With accounting, that's a slightly different approach. You put simply want your revenue to be higher than your costs, or you look at your costs to make a particular product, and then you add a profit margin, and that gives you your final price. So similar but different concepts. Also, I was taught, as and when I started looking at accounting, about the importance and differences between a balance sheet and an income statement or P&L, the balance sheet being a point in time, and P&L being for a period, and looking at revenues, looking at costs. And again, with carbon and with externalities, that can be quite a key difference to think of. And then two other concepts to mention here. Firstly, with accounting, the concept of fair value. And back when I was at the bank and I was moving from my very first role, which was in risk, and moving to a product control role, and I remember the CRO saying to me, the chief risk officer, all you need to know for product control, for financial control, is the difference between fair value and accruals. And said fair value goes up and down, it's at an arm's reach, it's the estimated price, and it's looking at a fair value for that particular asset, whereas accrual is your drip, 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 usually quite constant, doesn't move around quite so much. And it's an accumulated cost over time. And again, I think those concepts can be quite helpful when thinking about values. And the other piece to mention here is externalities, because in the IFRS standards, in many accounting standards, there's a really thorough way of measuring and disclosing the financial value of a company, of its assets, of its liabilities, of its activities. So lots and lots of focus around the financial value and that operational company view. But there are many other things that companies do and impacts which are outside its value chain. And often those are referred to as externalities in economics. They can be both positive, they can be benefits. But back when I was taught economics, it sort of went something along the lines of, here's lots of technical calculations and the way to derive those valuations and prices. And also there's these externalities, there's these other things that happen, but they're outside the company. We don't really measure them. And in fact, I think what's starting to happen now, and particularly with net zero, particularly with carbon emissions, is measuring those externalities, measuring those things which are happening outside as a consequence of a company or an organization's activities. And that also brings me on to intangibles. And intangibles are non-monetary. They can't be seen. They can't be touched or physically measured, but they form part of a company's value. So for example, that could be the value of a brand. It could be other types of intellectual property potentially that are included in that number. So it's something intangible that's in a company valuation, but it's not measured in the financial statements. And it's something, as it says, that it can't really be touched. It's not physical, so it's something else. And looking at this chart, you can see over the decades, when you look at market values of companies who are in one of the large US indexes, the S&P, a larger and larger portion of the market values of companies is intangible. It's intangible assets, and it's growing. And in particular, I was again looking at which company has the largest amount of intangible assets today. And the largest intangibles today is Apple. So in particular, technology companies can often have a large amount of intangible assets. And Apple has over $2 trillion of intangibles. They're not disclosed. And it's overtaken Amazon and Microsoft. They also have a large component of intangible assets. So when it comes to accounting, this externality piece that happens outside of the company, but is a consequence of the company, and then this intangible piece is really important, and it's often not necessarily captured very well in accounting standards today. So now focusing on net zero, and what's that all got to do with net zero, with carbon emissions? Well, many economists and market commentators say the failure to price the externalities associated with carbon emissions, because the full cost of and negative consequences of those carbon emissions is not priced into company valuations today. So the failure to price those negative externalities is one of the biggest market failures that we have in the world today. So there is market failure, and it's around a lack of pricing and a lack of bringing those externalities into company valuations. There's all sorts of other externalities, but for now I will just focus on carbon emissions. And also there's all sorts of intangible things that companies do which aren't measured today, which are in this area. And again, they're not being adequately measured today. So that's another area of focus. With carbon emissions, we are able to measure them. This is a slide which is an example from the Greenhouse Gas Protocol. And the Greenhouse Gas Protocol sets out 3 scopes of emissions. I think some people are quite well aware, so I won't go into huge amounts of detail, but you have scope 1, which is operational direct emissions in the company's control. You then have scope 2, which is indirect emissions. So that could be the electricity for offices, for example. And then you have scope 3, which is beyond the value chain of the company. Now, what this means is quite often when we think about accounting and financial accounting, we think about the company's own operations and the boundary being the company. But when we start to think about externalities and carbon emissions, you start to look outside the company. And for quite a lot of companies these days, particularly service companies, the largest source of their emissions, whether that's the emissions they're responsible for or is somehow in their value chain, the largest source of those emissions will be indirect. It will be their scope 3. So to give an example from the financial sector and a piece of research called Time to Green Finance from the Carbon Disclosure Project, it estimated 95% of the financial sector's emissions are scope 3. It comes from its lending, its investing, its financing activities. It's not the electricity that it uses within its buildings, for example, or laptops. And if you take, for instance, some of technology companies, so that could be Google, Meta, Salesforce, and others, and there was a report called the Carbon Bankroll. And this report showed if you took 10 of those largest companies, technology companies, and looked at the investments they have, so treasury, but also investments they may make, it increases their emissions by about 100%. So what this means is you can get very different answers and very different accounting depending on where you draw your boundary for your carbon emissions. And today, there's a tendency, and often for historical reasons, and it makes sense with financial accounting, to look at solely what the company has in its operations. But in fact, you miss out this whole huge other piece, which is really relevant. And even if the company isn't directly responsible, it's really important, in my view, to acknowledge that that's there and to disclose that it's there. So it might not be that the financial company is directly responsible necessarily for all its lending and investing with its customers. However, disclosing and acknowledging that link is really important. Otherwise, there are large components that get missed. But that's a challenge. And so that brings me on to greenwashing. And greenwashing is the practice of falsely promoting or giving a false impression of an organization's environmental work or resources or what it's doing in the environmental area. I'm not going to go into every single area here, but this is 13 different types of greenwashing. And this is from the University of Vienna. There's a template, which is an Excel template attached to this research, which is publicly available, and it has lots of examples. It's a really useful and helpful framework just to think through the different types and of greenwashing that there might be. And in my view, quite often this greenwashing is not necessarily coming with a bad intent. I mean, sometimes it is, but other times it could be quite well-meaning, but just unfortunately it starts to become greenwashing, giving that false view, that false practice. And I think at this point it's also worth noting just where the world is on carbon emissions, and looking at carbon emissions, they need to reduce radically from where they are today. That's 95% from where they are today. And there's scientific research to show that. Again, I'm not going to go the whole way through that today. There's a lot of reports if you ever wish to deep dive into that. But this year, 2021, emissions are still going up. They went up 6% in 2021 globally compared to 2020. And they continue to rise today. So for all of the talk and lots of what look like very good initiatives and discussion, still we're in a situation globally where those emissions continue to increase. And looking more broadly at the United Nations Sustainable Development Goals, which were created back in 2015 to be met by 2030, the world's not on track. All of the governments set out and agreed to those, or many did, but we're not near that. So I think with greenwashing, it's just worth noting that context. The planet isn't on track, and therefore many governments and nations aren't on track, and therefore many organizations won't be on track. So it's not necessarily bad to be humble and to explain that context. So what lessons can we take from accounting and many years of accounting? Well, doing nothing is also a decision. So even if companies decide not to measure any emissions, they don't want to set any sustainability targets, not interested, or maybe even individuals not interested at all, that's still a decision. That's a decision that's been made to simply ignore the issue, and it won't go away. It's not going anywhere. In fact, it will continue to escalate and accelerate over time in lots of different ways and lots of uncertain ways. But it's being aware of those decisions, even if the decision is to do nothing. I also think we could really learn something when it comes to carbon accounting and looking at sustainability from accounting disclosures. And IAS 1, International Accounting Standard 1, have a fair presentation of your results. And quite often, I think a lot of sustainability work has grown up from marketing and from communications. And that's not necessarily bad, but we need to know that disclosures are different. So marketing, how do I sell my product? Let me talk about all the good things. I have communications, giving a good view of the company, but accounting is having a fair and balanced view, talking about the good things, but also the areas of improvement which are required too. And accounting standards continue to evolve. Even with IFRS, that's still not set in stone. There still continue to be standards. There's still a US GAAP. So just like that, net zero will also continue to be a moving target. It will evolve. And also with fair value and accruals, that's another important point. There are many stranded assets. So these are typically fossil fuel assets, which are sensitive if there are changes in the price of energy. We've certainly seen that recently. And again, that's expected to fully continue. But those stranded assets with fossil fuel assets, largely they have a value on them. And now, depending on what happens in the markets and also with all sorts of other complex things in the world, they could have an impairment or they could be written down at some point in the future. And that's over $1 trillion that is sitting somewhere out there. So there's a huge accounting challenge and issue around that. And then also validation is an important point as well. Accountants traditionally have completed audits, signed off companies as going concerns. And I think being an accountant, I wish as an industry could be a little bit braver, because there are those organizations and companies out there where this additional information is required. And also we should challenge ourselves. Do I know enough to challenge? Do I know enough about this topic to challenge companies, to challenge as I'm looking at financial statements around, is this company a going concern? Does the claim or does the financial statement or does the disclosure do what it says on the tin? And that brings me on to the very last slide. And the quote here from Black Panther. And I think it's very easy with greenwashing and with sustainability to make it a purity test. So it has to be pure, it has to be so good. And even for myself, I'm often thinking, do I have the right diet? What about a car? What about this? And I think it is important to be credible and to meet those, to have these questions and ask yourself those questions. But at the same time, nothing's perfect. But I think it's around doing what we say, and trying to build bridges and reaching out to our institutes, our professional associations we're members of, to find out what they're doing on this topic, and ask ourselves, can we do more? And I'm part of Generation X. I was born between 1965 and 1980. I'll let you guess when. But I think for Generation X in particular, it's, no, what's our legacy going to be? What's going to happen when we're in those boardrooms, or we're asking those questions, or we're in our professional institutions? How do we build bridges? Can we be braver? Can we ask for more? And I think also being humble and being able to say when things aren't looking so good, and practicing what we preach. And I picked here on the left-hand side, this is the principles from SEMA. So this is the Institute, Chartered Institute of Management Accountants, of which I'm a member. And these are the principles which SEMA has, but I could pick other institutes, other companies that have their own visions, mission statements, and values. And I think these are really good principles, but I just look at those and I think, yes, this is what needs to be applied in practice to sustainability and to emissions, as well as to financial statements and all of the existing good work that financial accountants, management accountants, and other people who work in this space do. So really need to see that full spectrum of information, live up to those values, principles and missions that we have, and challenge ourselves. Can we do more? Can we be a bit braver? And how do we build those bridges? If you ever want to reach out to me, here's my contact details, also on LinkedIn. And thank you very much for your time today. I really appreciate it.
Well, Rebecca, thank you very much for this most interesting presentation. You really get to the heart of what needs to be dealt with. And I do have a question. There was one question in the Q&A. How do you avoid double counting Scope 3 emissions across companies?
Yeah, it's a great question. And my simple answer is you don't. Because otherwise you'll get into a sort of intercompany elimination type process. So I live with the double counting and I acknowledge it's there. So for example, in Scope 3, so those indirect emissions, let's just say if it's a bank and it has pro-rated shares of different companies to which it lends and invests, there could be some double counting in there. I put a footnote. There will be double counting potentially in this disclosure, and I acknowledge that I know that it's there. If possible, I try to quantify it, but otherwise it's very easy to spend lots and lots of time trying to do an elimination, which in the end probably doesn't add that much value. So I think acknowledging it's there, trying your best, but I wouldn't get too het up on it.
Right, understand. And have you had interesting experiences in bringing all these principles to corporations who may engage in greenwashing? How responsive have they been? What kind of success have you had with this?
Yeah, again, a good question. Yes, I have. So I've worked with a number of different organizations in all different sectors, all different sizes of company and all around the world. I think one thing I've learned is that just giving people the space to express the uncertainty and to work through some of the issues and to learn and acknowledge that not everyone has all the answers. I think that's a really important beginning. So quite often, let's just say it's a company in the financial sector. And I think quite often the financial sector is very good at talking about all the fantastic things it does. and looks for precision in forecasting and economic modelling. Actually, when you come to a topic like climate and net zero, carbon emissions are all estimated. We don't have drones and filters going up and measuring them real time or satellite data yet. So carbon emissions are estimated. Often the forward-looking financial information is estimated because I don't know what their portfolios will look like in 5, 10 or 20 years. And then the climate's changing as well. So constantly you have this reaction depending on what's happening in the atmosphere. So there's lots of uncertainty in there. And I think quite often when organizations are looking for precision, that can be a challenge. So I think number one, it's just being able to work through those uncertainties, what you do know, what you don't know, where the boundaries are, the different scenarios. And then secondly, and acknowledging not everyone has all of the answers here. No one in the world has all the answers. So it's emphasizing collaboration, but really trying to come at this from quite a humble and vulnerable tone. And I do see success there.
Ah, wonderful. We all have to hope that people will take this more seriously. Anyway, Rebecca, I want to thank you very much for your contribution. Very interesting and helpful. And we look forward to seeing you again soon.
Thank you very much.
Well, thank you, Rebecca.